everyone. Thank you very much for stopping by. I've been getting a lot of emails lately about how to avoid an actual stock market crash or even a bear market to a lesser degree. But one of the things that people fear the most in the stock market is a stock market crash, the likes of 1987 or 1929. It's one of those things that, we don't want to creep up on us, and in actual fact, in most cases, we got fair warning that they would actually happen. So I just thought I'd show you quickly a very simple way to avoid being in the market when a stock market crash could be happening, could be about to occur. It's a very simple method, and I think that's something anyone can do. Basically, all I've got here is a price chart, and each of these different bars is 1 week. So 1 bar equals 1 week. Over this period of time, it's about 2 years. And the first part I'm going to show you is a bear market and what to look out for. The theory that I'm using is actually called Dow theory, and I know it's a really simple tool. A lot of people do give a lot of weight to Dow theory, though, and rightly so, because it has given us fair warning of basically a bear market or a stock market crash that might be coming. Most recently in 2007. Now, so first of all, I'll look at 2007, then 1987, and then 1929 as well. So with Dow theory, what we need, it actually looks on the chart like a little zigzag. So keep in mind this is a weekly chart as well. And I'll just enlarge this a little bit for you as well. So this zigzag here, what we have is a peak, and then we have a trough, so as you can see there, but then we have a lower peak. So this one is lower than the previous one, as you can see, and then price goes through the previous trough. So that is your little zigzag pattern. When it goes through the previous trough, that triggers what is called Dow theory. Now that, according to Charles Dow, who obviously you probably know about Charles Dow, he's one half of the Dow Jones Index, and he lived around the late 1800s. So this was basically coined by him and refined over the years by a few other traders like Edwards and McGee, or at least brought to the main populace's attention. So as you can see, what happened in 2007, we had our phenomenal bear market, went down to, on the Dow Jones anyway, it went down to 6,500 points. Now, the next one I want to show you is 1987, because in actual fact, a very similar thing occurred. And this is the thing that basically I wanted you to be aware of so that you can look out for it when it might be happening and when a stock market crash might be about to occur. So, this is 1987 right here. And as you can see, it wiped around about 1,200 points off the market. And it was something that did take a lot of people by surprise. But the fact of the matter is that prices actually fell from the peak for around 7 weeks before the stock market crash happened. And we do have a very similar thing occurring to the Dow theory in 2007. So what we've got is our leg down, and then we did have a bit of a bounce, so prices did retrace, and that would give people a little bit of hope. But what actually happened then is prices went down through the previous trough. As you can see, we've got our little zigzag pattern here on a weekly chart. Now this isn't an exact replica of Dow theory, but it is a similar occurrence, so it's something that you do have to be aware of that might be happening in a few different shapes and forms, especially if we're to be aware of an actual stock market crash like in 1987. But still, fair enough, we do have our zigzag pattern. The very next week we had first leg down of the crash, and after that we had the actual crash itself. So as you can see, the crash did happen over 2 weeks in reality as well. So again, it's not something that really did sneak up on you if you're watching the price chart, because these things do show up in the price. So now let's go back to 1929, just so that I can show you the occurrence there as well and what to look out for there. Here is 1929. Now as you can see, again, we've had 7 weeks of price down moves from the actual peak, which occurred in September 1929. So that the price actually moved down for 7 weeks. So again, this does give you a fair warning before it does happen. But look at this. We still have our perfect little zigzag, which did happen over the 7 weeks. And that's our first leg down, our little bounce where people started to have a bit more hope, but then price went down through the previous trough. That triggered our actual Dow theory signal. So that's our Dow theory. Then we had the crash in October 1929. And November 1929 as well. So that one happened over 2 weeks as well, or even 3 weeks or 4 weeks really. So these things don't happen overnight, just to let you know. you will usually get fair warning if they're happening. If you see this zigzag pattern, then maybe it is a good time to lighten your positions. Just as a side note as well, it does work on the opposite way. If I just look at 1929, because the bear market after 1929 actually went for about 3 years, so that just was quite tragic. It was a huge thing, especially for people who were still holding their stocks. Now, if we look into 1933, you'll see we got the opposite of what we were looking at before. So it was a zigzag up, and this zigzag up is a Dow theory buy signal. Now that Dow theory buy signal basically gave us the signal for the bull market that was about to happen over the next couple of years here, and as you can see, it fell away there. We got a few Dow theory exits right around before that happened as well. One last thing, a tool that you can use with your Dow theory is the Humble trend line. As you can see, from the top of 1929 to the bottom in 1932, it did cross the trend line in 1932, but then didn't really take off until it got a Dow theory entry after it crossed the trend line. So that's, just another little tool that you can be aware of. Even if you don't use it full time, just keep an eye on the markets, and if you do see something, then it shows you that you should be aware, and have a look at the fundamental reasons why you're buying or selling a stock, and just take a second look, because these things can save you time and money in the markets. So I hope that's helped, guys. If it has helped, or if you do need more tools or more research, I've got all of that stuff free at my website, which is asxmarketwatch.com. Please stop by. It'd be great to have you there, and a lot of the stuff is free. There's a free course and the free research on stock market trends, which is just done by myself. So again, thanks very much for stopping by, guys, and I hope it's helped. Have a great week. Okay, bye now.